Is it possible for a manager to only select the best companies? In short, can an investment expert or guru predict the market? Well, let's start with this metaphor. Imagine you put out 100 young fish in a pond, and although they all have the same starting position in terms of size, it is difficult to predict which of them will eventually become the biggest fish. After all, some fish may grow quickly by eating lots of food and other favorable conditions, while others lag behind because of competition, less favorable light, predators, or other factors. Like fish farming, investors can invest in 100 different companies, but it is difficult to predict in advance which stock will yield the most returns. Some stocks may rise rapidly because of favorable market conditions and have good positive operating results, while others lag behind because of competition, economic factors, or other unforeseen events. Okay, but is this true? Isn't it possible for an expert to outsmart the market by insider trading, for example? And although insider trading is of course forbidden, let me show you the following example. Imagine you are a CFO of a company that sells solar panels and is listed on the stock exchange. In recent years, your company has been doing very well, and you have gone through the roof in terms of profits. This was mainly because the government used subsidies to encourage consumers to buy solar panels. But now you hear that those subsidies are likely to be reduced or even disappear altogether. Okay, then the next question. What would you do now? Would you buy additional shares of the company or not? What will this reduction in subsidies do to your company's profits? Or would those subsidies continue for 5 more years due to certain regulations? In short, as the CFO of a company in a particular industry, it is difficult to predict what the market will do and how it will affect your company's profits. Just because a company is doing well and making a profit does not automatically mean that it will continue to do well in the coming years. And so even with all the knowledge of that, it is still a guess how the market will actually react to certain messages from your company. And maybe the experts in the stock market have long figured out that your company is doing well, and so this has long been factored into the share price. Who's to say? So even if you think you're smart as an investor by investing in the largest company in the solar panel industry, that doesn't necessarily say anything about the future. There are always multiple things and scenarios that can happen that you can't predict. Consider a global player that was very successful in the market, such as a Lehman Brothers. Lehman Brothers, one of the oldest and largest investment banks in the United States. Lehman Brothers went into the second global financial crisis as a result of a global financial crisis. Or Kodak, once one of the leading companies in photography and film industry. Kodak failed in adapting to the digital revolution and went bankrupt in the second global financial crisis. Or Nokia, once a very large company that lost its market leadership and struggled to adapt to changed market conditions. In short, today's best top 10 is not tomorrow's best top 10. Plus, that it is difficult to select the best is evident from the following figure. Namely, this is a summary of global stock market returns from 2015 through 2024. Here you see Topix, a key stock index representing the Tokyo Stock Price Index in the blue area. It tracks the performance of the Japanese stock market. However, the Japanese stock index stayed at the bottom the following year. Notice the blue area, representing the Japanese stock index, considerably changes position over the years. And overall, the Japanese come in third when it comes to the 10-year average in terms of average returns. But could you predict this in advance? Why gamble on one country, one company, or one index when you can include them all in your portfolio and have an average of the overall global economy? This is why tracking an index is interesting. In fact, in this image, you can see the market concentration of the 7 largest tech stocks in the S&P 500. The S&P 500 is a leading stock index in the US, consisting of 500 major publicly traded companies. It is an important indicator of the US stock market. And in the illustration, you can immediately see that these 7 large well-known tech companies also directly represent a large share of the underlying index. When you invest in a global economy, you are basically tracking market indexes that track stock market performance. These indexes, such as the S&P 500, are composed of a series of stocks from different companies. The weighting of each company in the index is determined by its market capitalization. This means that larger companies with a higher market capitalization have more influence on the index because they have a greater weighting. And so this also provides greater influence and return in your portfolio if you follow this index. But suppose one company didn't go, the impact is many times smaller if you have 3,700 companies in your portfolio, if you only selected a handful of them. But then what if your name is a guru like Warren Buffett? After all, he does seem to be able to select the best company with selection. Why can he do this? Warren Buffett, although considered one of the most successful investors of all time, even he has acknowledged that he cannot predict the market. Warren Buffett is considered as an investor. And because of the size of his company, he can wield considerable influence at the shareholder meetings of the companies he invests in. But even this stock market guru advised his wife to invest 90% of his legacy in the global economy by getting into ETFs after his death. How did global investing come about, and how can you do it yourself? Because global diversified investing came about because active investors realized that while gambling on a single stock can be lucrative, it also carries significant risks. Finding that one perfect stock or selecting the top 10 remains a challenge because it varies from year to year. If you believe that the global economy will grow year over year and these companies have a bright future, after all, companies make profits. So why not invest in a global ETF, a tracker like VTI from Vanguard? Because with this global fund, you invest directly in 700 plus companies in developed markets at the click of a button. The biggest companies being well-known names such as Microsoft, Apple, and Nvidia, which is particularly big in the gaming industry, for example, Amazon or Facebook. You are widely spread across various sectors because buying all these stocks individually separately would be enormously time-consuming, not to mention the associated buying and selling costs. But in this day and age where technology has made great strides, it is becoming easier and easier to invest this way. But here's the joke, because if you want to buy this fund, you do so for an annual fee of 0.03%. And I know a lot of professional parties will then immediately say, yes, nice, but you can't purchase this fund as a consumer in Europe at all. And again, we can tell you that there are simple workarounds that we tell you about in our do-it-yourself course that allow you to easily purchase this fund as a consumer. And this is just completely legal. And of course, this is not financial advice. We want you to ultimately make the right choices for yourself. But this is just to show that it is possible. And if you didn't already answer the question, can you predict the market? The answer may be obvious. And to finally share an interesting fact with you, 12 of the 20 best trading days occurred in years when the stock market had negative returns and where most investors stayed on the sidelines for a while, waiting to get back in. Where 8 of the 20 worst trading days occurred in years when the stock market had positive returns. And this is, as you see, over a period from 1980 to 2023. The important fact is that stock markets and the global economy is growing over the long term. And if you believe the economy will continue to grow globally, then it makes sense to invest globally in a diversified way rather than gambling on a handful of good companies. Because data tells us that over the past 44 years, 75% of the time stock markets are up, and in 25% so will fall. But over the long term, this will give you returns. You can see more about this in the video, whose link I will share with you below this video. Until the next video, where I will go into when exactly is the perfect entry point to start investing your money. See you then.